Okay, good morning, everybody. I just wanted to wait there to see our numbers coming up, but I can see quite a lot of you online. So thank you very much for joining this session on growing without the pain, growth shares. My name is Ramsay, and I'm a tax partner at Gannons, and I specialise in all things to do with shares. And that's anything to do with shares and employee equity, be it options, shares, all the different types of share plans on the market. And I'm really excited to talk to you all this morning about share plans, particularly the opportunities that have presented themselves in the current economic environment. There aren't many silver linings to this pandemic, but one is an increased opportunity for share plans. I do want to start with an apology for anybody that did try to join me last week. I had a few technical problems. I hope everyone's understanding with the working from home environment and that not everything goes to plan. I hope it's been worth the wait for you to see us this morning and join us. And many thanks to those that now have the opportunity to join me as well. So I wanted to start with just sharing the agenda that we have for this morning. I plan on talking for around half an hour. We have an hour slot, but I do want to give everybody the opportunity to ask any questions that they want to. So hopefully you can all see the Q&A function on your screens, and please feel free to ask any questions. I will try and answer them either as we go along, or we do have a session at the end for Q&A. But I am really keen to hear from you all. If you've got any questions at all on what I'm talking about, or actually anything that you feel might be relevant that we skim across, then please do ask. To the extent we don't have time, I will answer your question afterwards. So I will get back to you. So this morning, we're going to run through quickly why use a share plan, and then also what the key opportunities are, and that's presented mainly through the budget and also some of the opportunities that have come out of the pandemic. Then going to move on to why would you use growth shares. I appreciate that not everyone will have a full understanding of the different types of share plans that are out there, but there are many types. The main ones are EMI, which is an option plan, and growth shares, which is a direct share plan. This talk is going to be focused on growth shares, but I will be bringing in EMI as an element to this because it is one of the more well-known plans. And I also want to show you a clever bit of planning that can actually help companies use both in tandem to maximize their tax opportunities. We'll then just look at a bit of the technical part, not too technical for Tuesday morning, but what are growth shares and how do they work? And then if we have some time, I wanted to talk about exit planning, because if you're looking to exit your business and an exit horizon of say 3 to 5 years, then you can never start too soon to prepare for that. And a share plan can be a great way to get your ducks in a row and make sure that you are investor ready or IPO ready, however you want to do it. A share plan will make that easier. And then we've got our Q&A. So let's start off with why use a share plan. So share plans have always been a key player for entrepreneurial businesses. Salary is without a doubt the main expenditure for SMEs. Most businesses, their people are their key assets. Now, salary costs, as we know, are heavily taxed with income tax and national insurance. We'll all know that from the pay slips that we either give out or we receive. That can be almost half your money going to the tax man instead of it being redistributed perhaps to your employees and saving yourself as an employer costs. For example, employer national insurance on any cash payments you make to your staff, you're paying 13.8% at the current tax rates. Not only that, but share plans do something that cash can't. Cash doesn't breed loyalty. Whereas a share plan offering equity, albeit through an option or a share, and we'll move on to that, is a way of recruiting and retaining your staff. If you offer somebody a higher cash salary, or you're looking to bring somebody on board and their asking price is quite high, that's not going to stop them potentially going off to a competitor and using your salary as a benchmark. If you offer them some form of equity on your business, and I'll talk through some design points on that shortly, then you're tying them in, because essentially you're saying, if you want to stay on this journey with me, then you need to remain in order to keep this equity. But if you do remain, hopefully you have helped increase the value of this company, as we do as shareholders, and reap the benefits in the end. Now, the star players on the market, those key people that you might either be trying to keep or attract at the moment, and with a lot of businesses, unfortunately, having suffered irreparably during the pandemic, there is a potentially more open job market to try and get those key players. The savvy ones do expect these share plans these days. They've become much more commonplace, and they'll be looking for quite a differentiated remuneration package. No longer is cash enough for some of these more sophisticated employees. They're looking for that deferred element of pay. And why? Well, one of the reasons is what we've just talked about, which is the fact that there is a tax saving to them. Essentially, we're looking to give them a capital gains tax treatment for their award, as opposed to nearly half their salary going to the taxman. Just as a bit of background to show you how much more this has come into play in recent years, share plans have been around for quite a while, but it was actually after the financial crash in 2008 that the government mandated in the financial sector, to start with at any rate, that at least 2/3 of pay had to be deferred. Now, this was as a direct response to the risk-taking activities of some of the employees in the banking world, where they seem to be being rewarded to take short-term risks. So it was a government initiative at that point to really push deferred pay, to try and make people look at the longer term of a business. Taking a short-term risk that does damage would affect them, instead of them just taking their cash bonuses out and running. This has now filtered through the rest of the sectors of the economy a bit more. So that deferred element of pay is now much more commonplace across all sectors, which is why share plans, albeit they've been around for a while, are much more at the forefront of planning. Tax efficiency, as I just said, cash is not always king. It's a phrase people use, but in this scenario, it's not, because cash means a high tax for both the individual and the company. And it doesn't breed loyalty, as I said. It will just mean that somebody has a higher benchmark to go out and potentially walk out of your business, taking their talent with them. I just want to show you an example on a rudimentary level, which is my next slide, to just show you what that means. And this is very much a rudimentary example. I'm ignoring annual allowances and other things like that. So it is a rough outline. But if we take an example of an employee, Chris, and he's earning a gross salary of £100,000 per annum. If we take that he is a higher rate taxpayer, which at the moment is 40% income tax, he's also going to be paying 2% employee national insurance, because there's always national insurance on a cash payment, whether that's a salary or a cash bonus. And then the employer is also then having to pay an additional 13.8%. Now, that's an awful lot of tax going to the taxman. So actually, you'll see that Chris actually comes out at not that much cash to what he wanted. And as an employer, you're either going to have to say, you're giving you £100,000 a year, but actually your gross is only going to be around that £45,000 mark. Or Chris might say, no, I want £100,000 a year, in which case you're going to have to gross that up. And that would mean paying that additional tax on. So that would mean paying Chris almost £150,000 a year, well, £145,000 a year, in order for him to have that £100,000. So what can we do about that? What we can do is try and offer the capital gains tax rates. And this is where share plans can come in to help. With the share plan, and this is any type of share plan, I want to stress, the focus of this talk is growth shares, but I will just go at the end of this slide to explain some of the other types of plan available. But generally, most share plans, we're trying to get individuals into the capital gains tax regime. If you get it right, and we'll go on to how you get it right, the main point being valuation. If you get the price right for this equity, be it a share or an option, then you can have no income tax or no national insurance on this award. As you can see, if I go back to the slide before, that's a big thing. Now, the capital gains tax regime, as it is at the moment, is that we either have a 20% rate or a 10% rate for shares. And I'll go on to explain a bit more about the differences between those two. But if we just assume a 20% rate at the moment, that is very good compared to almost half the money going away. I just want to take a step back at this point and explain why the starting point for HMRC would be that shares would be income. Because I can appreciate that most people look at shares and say, well, that's capital. HMRC don't look at shares in the hands of employees, and this includes employed directors as well, as the same as a share being held by an outside investor or an arm's length third person. It used to be that you could hold shares and be connected through your employment, and it was seen as capital. But HMRC got savvy to this, as they do to a lot of things, and said, well, no, hang on a minute. This is just another way of trying to pay your workforce. Therefore, we're going to say that this is the equivalent of just trying to get salary in people's hands, albeit in a form of a share rather than a cash salary. And that's something called the employment-related securities regime, which I won't go into as a technical point, but that's why our starting point always is when we have clients, how can we try and get out of the income tax regime? And this isn't any kind of tax planning or tax avoidance. It's mandated by the government in some legislation for some kinds of plans, or it's otherwise very common practice. And there are ways to try and ensure that you can get into that capital gains tax regime. Now, why use a share plan as well? It's getting employees thinking as shareholders. Again, cash doesn't breed loyalty. I can't say it enough. If you're the owner of your business, you obviously have your long-term goal ahead of you. You know the risks and rewards that you have to take to try and get on that journey. And if you want to align your workforce to think the same way, this is a way of doing it. Instead of them just thinking about when their next pay packet will be, and that as long as they don't severely mess up, they will still get paid. This is a way to promote good thinking and for them to think along the same lines as you, because they'll have a real stake in your business, and the harder they work, the bigger that stake should be. Now, shares or options, I wanted to bring this up to start with, because when we talk about a share plan, that can involve an option plan. The focus of this talk is growth shares and will remain that, but I can't not talk about EMI, which is a type of option plan. Essentially for SMEs, we see that the two types of tax advantage plans, these are the plans that offer this tax efficiency, are either, if you're looking at options, an enterprise management incentive plan, that's EMI, and I will go on to explain that a bit, or a direct share award. And with the direct share awards, the tax efficient way of doing that is under a growth share. Now, the two are different. One does involve giving a share up front, and one involves having the right to acquire a share, and that's the option. And there are advantages to both. And one thing I wanted to point out is that I am going to explain why growth shares can be very, very good for companies in circumstances where EMI is not always the best thing. But that isn't to say that EMI isn't an incredible tax advantage plan if you can have it. And actually the clever way, the clever solution to get the best tax treatment all around for a company would actually be to combine both of them. And I'm going to go on to that at the end to tie it together to explain how if you want the best of both worlds, then you can do EMI and growth shares together. Now, another advantage of having the share plan is that it can be a key factor for buyers and investors. So if you're still growing your business and you might be looking at an investment round coming up, or you might have your eye on the prize in the next few years of hopefully selling your business, then a share plan is a really good way of showing that you've really got your ducks in a row for an investor or a buyer. If somebody's looking to invest in your business or buy it, they're essentially buying the people in your business. Unless you're in a manufacturing business or it's asset heavy, generally it's the people with the knowledge that are growing the value of your business. What an investor, for example, doesn't want is to come in and put millions of pounds into your company only for your key players to walk out the next day. That's not what they're there for. They're there to make sure people are tied in. So we see in practice that investors love to see a share plan already there with a ring fence for employee equity, because it shows a real commitment to keeping the talent in your business. And it also, as I mentioned earlier, is a very attractive tool to recruit the best people in. And often investors might mandate as a condition of their investment that a share plan is put in. So why not get ahead and do that first on your own terms, rather than have to play by the investors' terms that they require for the employee share plan. Now, quickly, I just wanted to talk about the different types of plan. I've mentioned EMI and growth shares, but I do deal with all types of share plans here at Gannons. So I did want to let you know that we do cover all the other sorts. You may have heard of share incentive plans or company share option plans, CSOPs. But for SMEs, really, EMI and growth shares are the typical ones we see, which is why I wanted to focus on those. We move on now to the key opportunities. As I've said, as awful as the economic environment has been, there has been some silver lining for share plans, at least with the pandemic. And the main one of that is lower share prices. So I mentioned before that valuation is key for any share plan, and I will be going on to explain that a bit more. But the volatility that the markets have shown over the global pandemic has actually been a benefit to trying to put in a share plan. This is one of the few areas of business where it's actually good to try and argue that your company's worth less. That might sound a little odd for most of you, where obviously when you're looking to sell or to bring investment in, you're trying to argue a higher price for business. But what we're trying to do is argue a lower price per share so that we can get the equity into the hands of your workforce at a lower price. The big thing to point out here is this is a fiscal, not a commercial valuation. The commercial valuation of your business will be the enterprise value. It will be what you're looking at when you're looking to bring somebody in or value your business. This is a tax valuation. This is what the HMRC would see the value of a share is worth. The reason why these shares are worth a lot less to HMRC, which is what we care about for the tax purposes, than they would be on the open market, is that typically restrictions are put in place on employee equity to help lower the price. I've given some examples of some restrictions here, and these are things that you wouldn't typically see if you were giving a share to an investor. So typically with your workforce, you probably wouldn't want to make an award transferable. This is there because they're working for you. So you wouldn't want to give someone a share in your business and then they have the ability to transfer it to their children or their wife or their mother. The whole point is that they're holding that share due to their employment. So straight away, that's a restriction on the share that HMRC will say, well, it's not worth as much as an open market share for an investor. Next one is, we're talking about private companies here. Obviously, if it's a listed company, you can go into the FT, you can look at the price, you can buy a share. Private company shares are not liquid. So there's very few opportunities where they can be traded, and it's typically when it gets to a sale. So that lack of marketability is another big restriction which helps lower the price. We also often see forfeiture in certain circumstances. So again, unlike an investor share, you will put forfeiture conditions on employee equity. And by that, I mean that if somebody is fired from their job, for example, for gross misconduct, you typically take the award off them because it's linked to their employment. And this is where we have what's often called good and bad leaver provisions, which some of you may have heard of. And with the good and bad leaver, you have typically, if you leave for good reasons, which might be ill health, disability, you might get to keep your share or your option. But if you leave for gross misconduct or you go off to a competitor, it's forfeited. That again helps depress the value of the share for tax purposes. And there are a couple of other things. I'm calling it the COVID-19 factor, but we've certainly seen HMRC take COVID into account for the fact that it's less likely to be able to get your crystal ball out and see what's going to happen with your business. So even if you're going along with a good profit projections and you might have good investor possibilities, everything's so volatile at the moment that HMRC take that into account again, and that will help lower the value. And then the last one of these is performance. So depending, you can link the award of equity to an employee to their personal performance or the profit projections of the business, or even just simply as on an exit value of your business. Again, that's putting remoteness on the possibility of this award actually coming to life and being able to be sold. And again, that depresses the value. So these are all key reasons why the share price can be lower. And I'll explain why in a bit that's so important, but essentially, if you can set the value of the award, the share or the option to the value, the tax value, then that is how you make sure that you don't have to pay any tax nasties, any income tax or national insurance. So that's why it's so important. Now, the other key opportunity I've just put in there quickly is the budget. We were very glad to see that Rishi didn't do anything with capital gains tax, because as you can see, one of the main benefits of share plans is to try and get into the capital gains tax regime. We thought it was unlikely that the delta between income tax and capital gains tax was going to change, but we're very glad to see that it hasn't. I want to move on now to why you would use growth shares. So with growth shares, AMI is not always the answer. The first point of this is an option. Not everybody wants an option. You often find that employees, it's a psychological thing for them to hold a physical share, albeit a share that's got a lot of restrictions on it. For some people, shares are what they're looking for. And the whole point of these things is to incentivize somebody. So if they're not going to feel incentivized through an option, which has that extra step where you have to exercise it to actually acquire the share, then a direct award of shares is sometimes what people are looking for. Secondly, with EMI, there are very strict qualifying criteria. You have to be an employee or an employed director. One of the benefits of growth shares is that they're open to anybody. So you could give them to family, you could be a consultant, you could be a non-executive director. We don't have those strict qualifying criteria that's required for EMI. EMI also needs a qualifying trade. So certain trades are exempt from, well, they don't qualify for EMI. A lot of financial businesses and insurance businesses are barred from EMI. And so it's always important to look at what qualifies. If you also have a significant amount of investment in your business rather than a trade, then you're also going to run into problems. And then there's a gross asset test and employee numbers test. Now, I appreciate for a lot of SMEs, an asset test with a limit of 30 million and employee numbers of 250 group wide might seem rather large at the moment and not needed to be worried about, but it depends what stage you are at your life cycle. And you can rapidly grow and sometimes fall out of these tests without realizing it. If for any of these reasons, EMI is not going to work for you, you can mimic the tax efficiency to a large extent by using growth shares. And that's what we're going to go on to in a minute. We can still get into this capital gains tax regime, not pay the income tax and the national insurance, and still get most of those benefits, but without any of these tests and much more flexibility. The other reason why EMI might not always be the answer is, again, to do the valuation. Often EMI shares can come out much more expensive than the growth shares that I'm going to go on to tell you about. And that's because despite the restrictions that I've mentioned beforehand, which apply to all share plans, EMI captures the current value of your company as well as any future growth. So depending where you are in your life cycle, and we do sometimes see discounts of up to 70% for those restrictions on a commercial value, that still might come out quite expensive. And there is a £250,000 limit at grant on EMI options. Now, again, that sounds a lot, but if even despite the restrictions and the discounts, you're still coming out at say £200 or £300 a share, and you want to award a decent percentage to one of your workforce, that might not be looking as easy as it would. So, what are growth shares? As I've said before, it's an upfront share reward. That does mean someone's a shareholder from the outset. And as I said, for some people, that's very important from a psychological point of view. And there's no qualification criteria at all. So it is open to all, which is important as it's very flexible. How it works is you create a new class of shares in your business. So it does involve changing the articles. The advantage of creating a new class of shares is that it's just capturing the future value in your company. You're saying from the day that you create this class of shares, it will benefit in any gain of value from that day going forward. This can make the upfront costs of the shares very low. And I'm going to go on to show you an example in a bit, which will show you the difference with how much lower the cost of the growth share can be. This is done not only with the restrictions, but you're stripping most of the rights away from these shares. So we'd create a brand new class of shares and we'd say they've got no voting rights, they've got no dividend rights. Essentially, they've got a cap on being able to do anything useful with this share as or until a certain hurdle, which is what we call it, is achieved. And I'll go on to explain hurdles more. But a hurdle will be something like an exit value of your company at a certain price. It's something that needs to be achieved in order for the restrictions to fall away. And as I said, the right to participate in future growth means that you're not having to worry about the current value of your business, and that really helps lower the value. And the hurdles can be linked to exit scenarios, say an exit of my business over 15 million, something like that, or certain profit targets. And I will go on to give you some examples of that in a minute. Now, valuation specifically to growth shares. Unlike with EMI, you can't agree the valuation with HMRC for growth shares, but you need not to worry about that, because as long as a robust valuation is done with a professional firm, then you keep that in your drawer, you've shown your thinking, and if HMRC come to challenge it, you get your valuation out, and what they're looking for is just that you have had somebody look at this and try and determine the value, as opposed to you just sticking a number down on a piece of paper and not giving it any further thought. HMRC do only broadly have 12 months to challenge one of these valuations anyway, because the growth shares all go into the tax return. When somebody receives one, it goes into their personal tax return. So the period of time open to HMRC to actually challenge it is quite short. New participants. So each time you want to award growth shares to somebody, you will have to undergo a new valuation exercise. And that will be because hopefully the value of your business will have grown. So it's not a bad thing, but it does mean that you have to keep doing that. Now, that might mean the buy-in price is higher for later participants. But from a risk perspective, that makes sense, because the people that buy in earlier are taking more risk, and so they get us at a lower price. There's more certainty as a business grows that the hurdles will be achieved, and therefore the price will probably go up slightly, but that does seem fair in many respects to do with the risk that the individuals are taking. Now, if you set at the valuation price, there's no tax liability. So I've said this before, if at that valuation that you come out at, as long as you set that as the price the share has to be acquired at, and it is a share for gross shares, so the money will have to be found at that point in time. But when I come on to show you the workings of the numbers, you'll see that that price can be really quite low. Then there should be no tax liability at all until sale of those shares, and then that will be in the capital gains tax regime. So I said that will be at the 20% rate. Business asset disposal relief, I just want to mention that quickly, formerly known as entrepreneurs relief. Now, with gross shares, that's quite unlikely to qualify for, because you have a 5% test for economic rights. When we set the new class of shares at such a low value, it is quite difficult to get into the business asset disposal relief. But you'll see one of the tricks later on where I suggested you can combine EMI and gross shares. It is possible to use gross shares and still qualify for that, and we'll move on to that shortly. So let's look at an example. It's an example of a normal share award versus a gross share award. So here, Chris is to be incentivized with a 10% stake in his employer. Shares are worth £100 each. That's based on the last investor round. Often, when we're doing valuations, if there's a benchmark to be used, in a recent transaction, that's where we'll start at. And there are 100,000 shares in issue, so that gives us a very rough company valuation of 10 million. As I say, this is very rough and rudimentary. I'm just using this as a guide. So let's look at how that works. So if Chris was just to acquire his 10% holding, that would be 10,000 shares. And if there was no gross share class, and these were just the current shares, then with £100 a share, that would actually work out at £1 million that he would have to pay, or he would trigger income tax and national insurance. And that's because I said the government looks at shares in the hands of employees as being taxed like salary. So unless he pays the market value for them, then there will be income tax and possibly national insurance. It depends, I'm saying possibly national insurance on that, to the extent that there's a delta between what it's worth and what he pays for it. Now, obviously, that's not an attractive proposition at all. And taking a real commercial risk with that, even if he has deferred payment terms for it or a loan, he's still paying to acquire something that might not materialize. He might leave the business. It might not work for him. So that's quite a high and attractive proposition. So with gross shares, this is the example of how much lower you could get it. And again, this is very rudimentary. But with all the discounts and the fact that it's a brand new share class, as I mentioned, we could go from £100 a share to potentially £1 a share. Often you can argue nominal value for a gross share, or if not, then not much more. There's some hope value to them, but as I said, because there's no prior value to that share, it's possible to argue it a lot lower. Now, because of that, £1 a share, that 10% holding will mean he has £10,000 to pay, or trigger income tax and possibly national insurance. Now, that's a big difference for £1 million or £10,000 to essentially get the same holding in the company and share in the growth at the end. Now, you can gift growth shares or offer them at a discount. As I said, it's just that it will trigger income tax and national insurance potentially. But the delta between not paying anything and £10,000 is obviously a lot less than the delta between £1 million and not paying anything. So it may well be that you still feel you can gift these shares and take the tax hit. And then an example of a hurdle here would be, for example, that the gross shareholders would only participate once the ordinary shareholders get £100 a share. because as you remember, we said that the shares are worth, the ordinary shares, the current value is £100. So that's an example of a hurdle where these growth shares would only participate when the ordinary shareholders have essentially got their £100 per share back. So let's move on to the hurdle. So I've just mentioned it before, but briefly, it's you say that there's only any growth in the value above a hurdle, and therefore there's no benefit at all to value of the company below that threshold. And that threshold is normally set at a premium above the market value of the company. So for example, with the example I've just shown, where we said the company is worth 10 million, we might say there's no value to that share unless or until the company sold for more than 10 million. And what that does is the hurdle acts to preserve existing value for the existing shareholders. That's something EMI doesn't do, and it makes sure that the existing people aren't diluted, and that can be very attractive, depending on how you want to structure your awards. If you want people to just come in and benefit from the work that they're doing on day one going forward. I'm just conscious of the time. Okay. So this is a hurdle example, and I hope this makes sense. So again, taking the numbers we've just done, if we've got the company value at 10 million and we've got 10% under growth shares, and the share valuation of that growth share is £1 per share, because we've got this new class. As you saw from the previous slide, that will be pay £10,000 or pay tax on £10,000. If we set a hurdle at, say, 12 million, and say that there's no participation for growth shareholders unless the company hits 12 million and they sell for 15 million, that 10% stake that Chris is going to have, that will be 10% over the excess of the hurdle, i.e. £3 million, which is obviously the 15, take away the 12. And then that value on that 10% of that 3 million is 300,000, and Chris will be paying 20% on that. So that's £60,000 tax to pay, but for that 10% stake, which is obviously quite different to if it had been a direct share award. I put that down there so you can run through those numbers again in your heads, but hopefully that makes sense and shows the benefit of it. So I just wanted to move on to what documents do you need when we at Gannons look to do our growth shares and speak with our clients. There are certain things that are required. So the first is that we have to go and change the articles because we are putting a new class of shares in. What I did leave out there is the valuation. That's important. We do the valuation is done as well to make sure that we're setting the right price. And then you can decide whether you want people to pay that price or to pay the tax on the difference. We have subscription agreements, and that's what people sign up to. That's the legal contract for them to actually acquire the shares, and they'll contain all the restrictions in them, such as what happens on forfeiture and things like that. The next point is really important. I don't want to make it too technical, but there's something called a Section 431 tax election. And essentially what this does is it stops any future tax nasties happening with these shares. So if you acquire the shares at the right value, there should be no more tax consequences at all. What can sometimes happen is when restrictions fall away, that can sometimes create a taxable event that can come and cause a problem on disposal. So I'm more than happy to take questions on Section 431 elections, but for the purpose of this, I wanted to keep it simple. But essentially, we get people to sign up to a Section 431 tax election. There's really nothing to lose. It's not filed with the revenue or anything. You have to do it within 14 days of acquiring your shares. I mean, it just confirms the tax treatment, and it just confirms that this is what you're paying. This is what you paid is the value, and there's nothing further to worry about. And then they're kept in a drawer, which might seem a little old-fashioned these days when everything's online, but that's the way it is. And it's kept in a drawer in case anyone comes to question it, and that's your proof. And that's really important on a due diligence exercise, for example. That will often be a question a buyer will ask, have people signed up to their 431 elections, because they don't want any tax liabilities crystallizing. So it's just a process that we do, that people sign up to that when they acquire their shares. I mean, obviously there's board minutes or any shareholder resolutions that need to be done, and then the company's house filings. Now, I mentioned before about being clever, and this is where I just wanted to tie up EMI and growth shares, because as I said, growth shares have the benefit of being much more widely available and much more flexible, and also you can get them at a lower cost. So what you can do is have EMI over growth shares, which is the best of both worlds. So what you could say is those that do qualify for EMI, they could have EMI options over those growth shares. So where that value for maybe EMI purposes is quite high, for the reasons I mentioned before, because of the current value of the company being taken into account, you can lower that by doing it over growth share. The benefit of this is you get corporation tax deductions for EMI options for business that you don't get with the direct share award. Now, these can be quite hefty. It's equivalent to the gains made on that whilst under option, and it can either be used to deduct against your corporation tax or put against losses. And when you come up to a sale of your company, for example, it can be seen as a deferred tax asset in your balance sheet, and it can be something. It's a good bargaining chip, basically, on a sale, because that can be worth quite a lot. The other benefit is that you nearly always get entrepreneurs relief with EMI options. That's because the test I mentioned before about the 5% test for growth shares, that falls away with EMI. EMI is one of the few ways that you can get benefit from entrepreneurs relief, formerly known as entrepreneurs relief, as long as you've held your shares for 2 years. And that counts the time under option, which is really important. So that would work with what we call an exit only option, where somebody is essentially just holding an option up until sale. So you can get the benefit of that with a growth share, and you can also benefit from the corporation tax deductions. So that's the benefits from the EMI perspective, but you get the lower costs of the growth share, and you also get the widening. You also then get to offer growth shares to people that aren't employees. So these can run concurrently in your business. And as you grow, you may find that EMI works well to start with if you've got low values because the company's at the start. You've just got employees. But as you grow, you might want to bring on some consultants. You might want to raise money from family and offer them a stake in the business. And you also just might find that EMI gets a bit expensive as the value of your company goes up. So having both in tandem can really work. And then the final advantage is, as I mentioned before, you can't agree the value of growth shares with HMRC, but you can agree EMI. So if you do EMI of growth shares, then essentially you are getting your growth shares confirmed for the value. So those are the main topics I wanted to cover. I appreciate that it's been quite short and sharp, but I'm just going to have a look at some questions now that have been coming in. Do you keep sending them? So I've got one from Stephen Charles saying, heard that HMRC are asking more and more questions and being more difficult regarding growth share valuations. Is that my experience? Yes, it used to be the case that you could pretty much argue a growth share wasn't worth anything. HMRC have got a bit more savvy to it, and they'll be looking at things like the hope value of the growth share. So it's quite unusual now to get to say that they're not worth anything, but they're still worth an awful lot less than other shares because of the fact that they're just capturing that future growth. So it's always a case by case basis with each company. Valuation is an art, not a science. So we have to take it case by case. But yes, they are looking to try and increase the values slightly by putting a hope value on it, essentially saying, well, it can't not be worth anything. If anything, because you brought professional advisors in to set up a growth share. If you spent £10,000 putting a growth share arrangement in place, how can you argue it's not worth anything? That's the kind of thing that they might look at. But it's still the best way to get equity into the hands of your employees at the cheapest price. But yes, we have seen them having a stronger argument about the valuation. Just let me look at some more. Okay, I've got a question from Tom. Hi, Tom. Tom Hicks, my friend, good friend. My current thinking on joint ownership awards. Okay, so this is slightly out of the spectrum of this talk, but I did mention that I do lots of different types of share plan, and one of them are joint share ownership awards, which are another direct share award, but involves a trustee. I think I'm going to come back to you on that, Tom, because it's slightly out of the ambit of this talk, and I don't want to overcomplicate things. But it is good just to point out, as Tom has, that that is another type of share plan as well. And that also looks to lower the value of the equity in people's hands, but it's through a different mechanism. It is more complex, and it does involve more professional costs. So I will leave that one out. Gross shares are more straightforward if you can use them. But it is good just to point out that if anyone's heard of JSOP, that's another type of award that I do offer as a service. So this is a good question from Andrew. Thank you, Andrew. Do gross shares and changed articles mean the company is no longer EIS qualifying? So this is an important point. If you have EIS or SEIS investors, you do have to be careful with share plans. And that's because you have to make sure that there's no preferred rights for people that hold EIS or SEIS shares. So you do have to be very careful. We have to take that on a case-by-case basis, Andrew, but you're right that sometimes it's not going to be the best thing if you have EIS or SEIS, and that actually is for all share plans. That's for EMI as well. So we really have to be careful about the preferential rights. So thank you for pointing that out, and that was something I was going to mention if I had enough time. What size hurdle, Sarah's asking, what size hurdle would I recommend if a company is worth, say, 10 million today? Beyond what size hurdle beyond the current value? Well, Sarah, it really depends on what you think if you've got any gauge of what you think your business is going to be able to sell for. Share plans are always a balance between what's going to incentivize somebody and how you're going to tie them into your business. If you set a hurdle that's too remote, then that might not incentivize that individual enough. But the more remote you set it, the lower the price you're probably going to get for it, because it would be seen as a more remote possibility of the share ever having these restrictions drops and the person being able to sell them. So although it would lower the price for acquisition purposes for the individual, it might not work as an incentive. I would probably typically say, as you have there, between 10 to 20% beyond the current value, but it's really for the owner of the business to look at, and they know their business best, what they think they realistically could have, say, as an exit value, and what's going to work psychologically for that individual. Now, you can have different hurdles for different people. You can have different valuations. It's very flexible. So what works for one person might not work for another person. But typically, I'd say you want to have that balancing act between it being enough of an incentive, but not off-putting. It's that kind of carrot that you dangle, saying, look, this is what you could have if you help us achieve this growth. Okay, so sorry, I'm just reading here. So Simon says, you've said that HMRC is 12 months to challenge valuation, and that they're likely to know about the issue of gross shares because holders of those shares must declare them on their personal tax return. How and why do shares get reported on person's tax return? So because this is going into the capital gains tax regime, there will be a declaration in there, and that's also where, if you can, you would claim your entrepreneur's relief. And then generally there's an inquiry by window for personal tax returns for HMRC of 12 months. So that's why I've said that. The company itself, though, has some other reporting. So that's from the personal tax position of the participant. But any type of share plan, and this goes not just for growth shares, but for EMI, J stocks, all of them, they have to be reported to HMRC by the company, and they have to be registered online. So HMRC will know about the existence of any share arrangements. And that's actually not just a share plan, that's if you give any kind of equity to employees or employee directors. It's something called the ERS portal. It's an online registration. And you have to register new plans with HMRC, so they are aware of them. So it's both ways. HMRC will know it from the company, but then it's a declaration from the individual about the actual value of the awards that they're getting. I've got another question here. An estimate of a plain vanilla cost of implementing a growth share plan with Gannons. Well, it really depends, again, on a case-by-case basis, but we look to be very obviously very competitive in our costs, because we really do understand what the entrepreneurial business is looking for, and we try and simplify things as much as possible, which I hope you've seen from this talk. So typically the main cost is the valuation, and again, that will be dependent on the type of hurdles that you're looking to put in. If you're looking to put in something you know, along the lines of an exit value of any value, any exit over the value of, say, 15 million, and the company's worth 10 at the moment or something like that, that's more simple planning. We do work with specialists with the growth share valuations because they are more complex than the EMI ones, and so typically you're looking at around £5,000 for a growth share valuation, but that is the main part. And then the subscription agreements and the drafting together with that is probably around another 5 to 6, but it really does depend. And you know, growth shares are, like any share plan, very much dependent on the facts in place. But once you've got your structure in place, like any share plan, you've got your template agreements. It's a question of just refreshing the valuations. And if you can do the EMI over the growth shares, then we can get that EMI valuation agreed with HMRC. And EMI valuations are less complex and can be typically around £1,500. So there's cost savings to be made by putting them both in place. But having that value agreed with HMRC is a key thing that can really benefit, because you don't want HMRC later down the line to come down and say, we don't agree with that valuation. But we don't typically see that if someone's actually gone through the process of getting the valuation done by a professional firm, such as Gannons, because they're just looking to see that somebody has taken the time and effort to come up with a value. I've been asked, does that include changing the articles? Yes, it does. That does include changing the articles. So we typically, with the articles, we put in a new class of shares. We look to put an employee shareholder section in there, like to put the, because it's different from obviously the owners holding shares, and that's where we put the examples of the good leaver and the bad leaver. And then we might put what we call a waterfall into the articles as well, which is who gets what out on an exit first. And that would be an example of a hurdle where money would go to the existing shareholders first up until that hurdle, and then it would be pro rata. So very much look to, it can be very flexible what you do, but they do work very well. It's very efficient. And the name of the game really is to convert income into capital, which, you know, means that you can give more for less, essentially less equity to your employees, but it's worth more because, you know, half of it isn't going to the tax man. So I'm just going to have a quick last look at these questions. As I said, to the extent that I haven't answered any of these questions, I will come back to you and give you all a quick answer to your questions. And I'm always here to, you've got my contact details here on the last page. And I'd love to hear from you all. And if anybody's got any further questions, you can contact me there. But essentially, yeah, I deal with all aspects of share plans, and I have been for a while. And I really think that the time has never been better to look at employee equity in your business. It can really manage cash flow costs at the moment, and gosh knows, you know, we all need that. And it's a way of locking people in and freeing up your cash reserves for the future future expenditure on things that need it, while still time people in. So thank you so much for joining us today. I hope you have a good rest of the day. And we'll be sending something out to you all as well as a thank you for joining. And I look forward to hearing from you very soon. Okay, everybody, many thanks. Bye-bye.